Welcome back. Welcome back to another edition of Sunday School with your boy Buck Bandit P, man. Appreciate y'all for coming back here, man, for another week of Sunday School, another time to get our learn on, another time to have a chance to go out here and get this money. You already know the slogan, man. That's what we doing on 2026, man. We focused on peace, prosperity, and printing money. You already know. Let's get it, man. So let's jump right into it, man. Today, man, and this topic goes right along with the previous topic. So if you didn't see the other Sunday schools, make sure you go check them out. Make sure you go, and definitely before we get into it, make sure you subscribe to the channel. Make sure you like the page. Make sure you hit the notification bell and all that good stuff. Definitely make sure you follow me on IG. That's where, you know, all the fire be coming on IG, man, you know, because that's just where the place to be. You know, on IG. So make sure you following your boy. And definitely make sure you subscribe to the Buck Bandit Podcast Network so you can tap in to that Buck Bandit Podcast because, man, it's on fire right now. You hear me? So let's get right into it. Let's get right into the nitty gritty. The topic today, man, is risk versus reward. We have to talk about risk versus reward. This is so important to talk about because if you new here, like I said, go look at the other videos and you're going to see why this goes into this, because a lot of times people think of these get rich quick schemes, or I'm gonna get rich quick, or I'm gonna flip my way. Like, I'm gonna make a video too. Definitely, this is why you gotta be on my IG. I'm gonna make a video too about why lottery winners like always lose their money. Because I got a feeling I know the answer, but I'm gonna actually do the research and look it up just to see. Because you're not gonna flip your way to wealth, man. You ain't gonna do it. Ain't nobody did it yet. Some people might say, oh no, such and such flipped their way to wealth. Man, I can guarantee behind the scenes it was a lot more than flipping going on. It was a lot of hard work, preparation, and you know what I mean? And just sacrifice going on behind the curtain. But man, today we talking about risk versus reward and why it's so important, man. So, you know me, I'm not into that financial jargon and talking over people's heads and you gotta figure out the philosophy. We're not doing none of that. We breaking it down so simple people, regular people can understand these simple strategies. That's all it is. They wanna give us all this language to try to confuse us so we won't invest. But you here, so we past that now. So let's get right into it. What is risk? What is risk? Risk is not oh, I just lost everything. Oh, I risked it all and I lost everything. That's not necessarily true, because you could lose it all and you ain't risked nothing. You could have, so quote unquote, you didn't risk nothing. You went to school, you got a good job, you did all that, and the company you've been working at for the past 20 years went out of business. Now what? You ain't risked nothing, but you still lost everything. You lost your job, you lost your house, you lost your pension, you lost it all, but you didn't risk nothing. So we gotta understand the terms we gotta understand what these words really mean before we wanna just go applying them in our life and just start making permanent decisions off terms that we don't understand what they mean. So risk is not you losing everything. Risk is simply you feel like you're in danger, in harm, or you're going to lose something. That's all it is. Like when you're exposed to danger, harm, or loss. So the main reason why people don't want to invest is because they think they're going to risk losing some money. So let's break that down. Let's break it all the way down. Why do they fear they're going to lose some money if they investing in the stock market? Well, because one, people been told the stock market was a scheme. I was told the stock market was a scheme. All I knew was people that got schemed by getting in the stock market. So I get it. I understand. So that's why people think it's a risk if you put money in the market because you're going to lose it. However, you only lose money in the market if you sell. That's what they not telling you. If you or if the company goes bankrupt. The company go bankrupt, then yeah, you're done. But That hardly ever happens. When companies start going bankrupt, you seen what happened. We have bailouts, buyouts, all kind of stuff happens to make sure these companies don't go bankrupt. Like, that's what we're not understanding because we're on the outside looking in. Now that y'all here, I'm happy y'all coming to the inside. Like, come to the inside, peek behind the curtain and see what they doing and see what they talking about. So you think you're gonna lose your money if you put it in the market because that's what you've seen, that's what you've been taught, that's what you've been told. But however, you don't lose anything unless you sell lower than you bought or the company goes bankrupt. And the company goes bankrupt, all hell is breaking loose. Recessions is going, when companies go bankrupt. We've seen it. We've seen what happened. If you my age, you old enough to see what happened when people go into foreclosures heavy and the banks start calling debts and people rates start going up and they start losing their houses, people losing jobs and companies going out of business, banks going out of business and all that. We've seen it before. So we can't be scared to put money in the market thinking that it's a risk. To me, now that I look behind the curtain, the risk is putting all your chips on a job. And we'll get into that later into this, but just betting on a job, like I'm gonna work at this job and this job, I'm gonna do my time and they gonna give me my pension. That's not guaranteed anymore. You could do your 30 years and then when it's time for your pension, go look it up. Don't take my word for it. Don't take my word for it. People trying to get their pension now and got to go to work now, and they thought they was supposed to go and retire, but they can't retire or they don't got enough money to retire. Like, it's a lot of stuff that they not telling us, and I'm happy you're here because I'm gonna tell y'all. So, why is it dangerous to weigh these risks and reward this way? Because let's put it this way. I broke it down in my other video. Make sure you go tap into that. Let's talk about saving. People who love to save. I'm going to save. I'm going to have this cash under my mattress. Cool. Like, you ain't got, your risk is very minimal. Unless your house burned down, which it rarely ever happens, but it's a possibility. Unless your house burned down, you're going to have all your money. You're going to be good. However, that same amount of money under that mattress is not going to have the same purchasing power next year. We already went over that. Go watch the other video. So it seems like you're playing it safe and you're going to come out better and all that, but you're not, because you're never going to beat inflation with your cash sitting under your mattress. Let's go to the next one. All right, I'm going to put it in a savings account. That's better, right? I mean, it is better than under your mattress because at least you won't be losing all the way to inflation because the bank will give you like 0.2% or something crazy. So basically, if you have like $1,000 in the bank for a whole year, they'll give you like $2. That's what I'm saying. So that's risky also. If you ask me, I'm just going to have all my money in the savings account forever and they just going to give me $2 for every $1,000 I have in there. That don't even, it's like, hold up, it got to be another way. There is. So let's go to the next level of risk. The next level of risk is index funds, ETFs. What I talk about, a company that just buy a whole bunch of companies and you invest in them, and then now you don't got to invest in the individual companies because they did all the homework. Like, that's less risky than the next level, but it's more risky than saving and having money under your mattress. However, the returns, we already went over that. 20 years of having your money just in the S&P 500, regular index ETFs. You go on in 20 years, that compound interest is going to be way better than you just having that money in a savings account, and definitely way better than it having it under your mattress. Let's get to the next level of risk, because there's levels to this. Ain't that what Meek said? The next level, individual stocks. Definitely more risky than index funds, definitely more risky than a savings account, definitely more risky than having cash under your mattress. However, you invest if people who invested in Tesla 20 years ago, they retired today. They doing something else because they went with the risk, but the upside is way higher. They up 10,000% on a stock. But we gonna get into that. I wouldn't advise putting all your money into just one stock. We gonna get into that because that's part of risk and reward too. And the next and final, well, maybe not the final because there's more, but the next one is options in crypto. That's the highest level of investing risk, in my opinion. crypto and options. You don't want to do that unless you already got these other, unless you already got money saved under your mattress, you got money in a savings account, you got money in index funds, and you got money in stocks. All right, now you can go mess with some options and some crypto. Don't jump out there. People got crypto. It's some people I know who got crypto and don't know nothing about investing. You ask them about a Roth IRA, they be like, what? But they telling me about XRP. And don't get me wrong, that's one of my top 5 cryptos. But however, it's you on level 5, but you didn't get the level 1. You didn't master level 1. We can pull up the graphic. Most Americans don't have $1,000 in a savings account, like for an emergency. So if you don't have $1,000 in a savings account, how you on level 5 talking about something? I'm a day trader and I be trading every day, but you ain't got no cash. Like make it make sense. So we got to understand this risk and reward. Like we got to understand the levels, and we have to get to one level before we get to the next level. Stop skipping levels and try to jump all the way to the next level. So let's get to point number 2. Number 2, time reduces all risk. Time reduces all risk. This is why staying invested is so important. This is why I talk about compound interest. This is why I tell y'all do it now and don't wait until later, because time, what they say, time heals all wounds. It really do. Like you was mad. I'm pretty sure some of y'all was real mad like a year ago, and you don't even remember what it was mad about. Probably got in a fight, probably got injured or something years ago, and you don't even remember what it was about, because it's not even that important. You don't care about it anymore, because time heals all wounds. And the same with investing. Time reduces your risk, because if your portfolio is down 10% in a year and you just put money in, it's your first year in the market, that's going to hurt you. You can be like, oh, I don't know what to do. I'm taking all my money out. And that's why a lot of people take their money out real fast when they first start investing if things don't go their way. They be like, oh, no, it ain't for me. I'm out of here. It ain't going to work. But what you not understanding is 10% that first year going to hurt. 10% that 10th year, you're going to be like, oh, whatever. Next year will be an up year. Now, because you had 10 years in the game, you already know it come with ebbs and flows. You already know that 10% down year going to lead to a 15% next 3 years. And you see what I'm saying? Like, but you ain't going to know that until you get in the game and start playing and stop being on the sideline and saying, oh, I'm scared. Oh, I'm just going to save my money, or I'm just going to work at this job. As you could just see, I pointed out, that's risky too. It's all risk. It's just about what kind of reward you want for your risk. And you want to stay, what they say, stay 10 toes down. You want to stay 10 toes down so that way when stuff happens, it's like, I've been doing this. Like, I ain't worried about no Trump and no terrorists. Like, it's cool. I'm just ain't going to put no options in this, you know what I mean, until I figure out the temperature of the market. That's all it is. Like, because you already mastered saving. You already got savings account. You already know about high yield. You already know about the indexes and the ETFs. And you already know about the individual stocks that you're looking at. And so now it's like, all right, let me nibble on some crypto. All right, let me put a little option call in, because you already mastered it. Oh, all right, now you see the temperature of the market. Let me not play with no crypto. Let me not play with no options because Trump and they're acting crazy. What? But you know what to do because you already measured your risk and your reward. So let's get to the last and final point on this risk and reward topic, man. And this last one, man, I had to save it for last because it's a good one. It is not a flip. I'm going to say it again. Investing is not a flip. It is not a flip. It is not a flip. Investing is a long-term, lifelong decision. It is not a flip. So don't go in it. Yo, XRP, man, all my checks for the next 6 months, I'm putting in the XRP. Don't do it. Don't put, for the next 6 months, don't put all your money in the Apple. I wouldn't suggest doing that, even though Apple is a great company, even though they got their primes right now, Google eating their lunch. Even though Google is a good company, Nvidia is great. I would not suggest you taking all of your money and putting it on one stock, one company, or anything that I say or any other of these influencers say. Diversification is the key. People are going to tell you, no, go all in on one thing. You ain't never going to do it if you don't go all in. They want you to be poor and broke. Diversify. It's definitely good to say, all right, I'm focused on this because I like this stock, so I might be putting a little more in here. But still, don't neglect your Roth IRA. Don't neglect your savings account. Don't neglect your kids' custodial accounts. We're going to get into that. Don't neglect your ETFs. Don't neglect all of that, your cash under your mattress that you need at the crib. Don't think just because you shouldn't have cash at your crib. Like, so don't try to get into this investing stuff. First of all, if you ain't got no cash saved up. Like, I'm gonna do a video on a checklist of what you should have before you invest. Like, and I don't want to say don't do nothing, but you can invest through your job. If you have your job, invest that way. Do your 401k match for you. Whatever your retirement plan is for your job, I'm pretty sure they give you a match. Do that match for a year before you actually start investing in individual stocks yourself. That's what I would suggest. So that way you can start building up a nest egg. You know what I mean? Because you don't want to put all your eggs in one basket. That is bad form. That's a bad job. So we're going to go over the 3 again, and then I'm gonna get out of here, man. Risk and reward. What is risk? Risk is nothing but being exposed to danger, harm, or loss. The reason why you think investing is risky, because you think you're gonna lose your money. But people, or you think you're gonna lose your lifestyle. But people that lost money and lost their lifestyle being at a job and saving money. So you gotta realize, how am I gonna weigh this risk versus this reward so I can get better upside and no downside? Because I guarantee if you never get in the market, you're never most likely you're never going to be wealthy, because even if you hit the lottery or some stuff, if you don't have these principles into place and these strategies and these disciplines and these habits already in place, most likely you're going to give that money right back because you don't know what to do with it. And so let's go over it. Risk, exposing yourself to danger, harm, or loss. Time, number 2, time reduces all risk. So the longer you stay invested, the less them swings hurt, them downtrends, the less they hurt you, the longer you stay invested because of compound interest. And number 3, diversify. Never put all your eggs in one basket. Never put all your money on one stock. Never just go all in on one thing. You want to make sure you CYA. You want to CYA. Cover your ass. So, thank y'all for being here for another edition of Sunday School, man. I love y'all. I appreciate y'all. Make sure y'all hit that like button. Make sure you subscribe to the channel. Hit that notification bell so you can see all the fire that's coming out. Make sure you following your boy on IG. Make sure you subscribe to the Buck Bandit Podcast Network so you can tune into the Buck Bandit Podcast every week, man. You already know what it is, man. It's your boy Buck Bandit P. And you have watched another episode of Sunday School here on the Financial Corner. And let's go out here and get this money.